Okay, so we've had some simple problems and so on. Let's talk about uneven cash flow. Uneven cash flow, we've had payments that are all the same, mortgage payments that are all the same. We've done that. That's kind of simple. You're probably doing it on a calculator already. So let's take just a little bit and think to ourselves about uneven cash flow, and that gets us into NPV and IRR. NPV is our definition here. Net present value is net present value, and it is the difference between the present value of the cash inflows and the present value of the cash outflows. So we know what a present value of the cash inflows are. We take our cash flow and we discount it back to the present value. That is the present value of that cash flow. And if we take the value of our cash outflows and subtract it off, we get the net, or the difference between the cash flows. The cash flows coming in and the money going out. Now this is perfect for valuing a stock or a company, or valuing a project, anything that has a stream of cash flows. We want to make an investment in the company. We see what the stream of cash flows in. We discount it back at a specific rate, and we make the investment. Now, the corollary to that is IRR. IRR is defined as the internal rate of return, and it is the discount rate that makes net present value equals 0. So you have this cash flow stream that's discounted at some particular value that gives us a number, and then we subtract out the money we invested, and we get a difference. Well, those numbers will always be a little bit different, except when the discount factor of the present value of the cash flows is exactly equal to the amount of money going out. When those equal and the difference is 0, so we put as much money out as we got back in, the present value of what we got back in, that turns into a discount factor that we call IRR. So it's basically break even. The money you went out is what exactly came back in, and that is the rate of return you will get on your investment. So we look at net present value and we look at IRR as ways to measure investments. So let's take a problem, and maybe this will help you grasp this. The present value, the discounted value of cash today, we just did this problem, $100, $100, $100, $100 for 4 years, and we discount that back. And we discount back, we find that the first $100, I need to deposit $90.91. If I deposit $91.91 today and I get 10% return, I will have $100 at the end of a year. The 82.64 is 2 years, 75.13 is 3 years, 68.30 is 4 years, for a total of $316.98. If I deposit $316.98, I can withdraw 100, 100, 100, 100, 100 for the next 4 years. That's how you get the present value. That's what the calculator is doing. It's an easy mental mental picture for you to imagine. Now this is just the present value. Now the net present value is how much did I pay to receive that $316. So I didn't have to deposit $316. That would give me a 10% return. What if I deposited $200? I would get more than a 10% return. I would have a positive net present value. It would be $316 minus $200 would give me a positive net present value of $116. If I deposited more than that, say I put $400 into it, it'd be $400 minus $316, and it'd be $85 and change that I would lose on the transaction. So the net present value is how much did you invest, and how much is the present value of that future cash flow. The discounted cash flow is the secret to calculating the value of the investment going forward. So we have net present value as being very, very important. Second thing is IRR. IRR sets NPV to equal to 0. So the amount of money going out is the amount of money coming back. So we change the discount rate until the present value equals the present value of the cash inflows equals the present value of the cash outflows. So net present value is the place that tells you your rate of return on the investment. If you had thrown in X amount of dollars, the discount factor that gets you back to just that exact amount is your internal rate of return. It'll be a little more obvious, I think, in this problem. Let's look at this first problem, and I think it'll be easier to see. So the first problem is we want to compare two projects, A and B. NPV allows this comparison, of course. So project 1, P1, is 40,000 out. That's at time 0. That's the present value of the outflow. The inflow is 15, 12, 5, 10, 10, 10. The total cash there in the end is simply the net of the present value, or the net of the total of the cash inflows and the total of the cash outflows. That is not a net present value. Some people might look at that and say, well, the money I put out was 40, the money comes in is 57,500, and so 57,540 is I made 17,500. That's not true because of the time value of money. So we don't do the problem that way. I put that there to show you that that is not the way to do it. P2 here is 55 out, 15, 15, 15 in, along with 16 and 17.5, which has more total cash involved, of course more total cash out as well. So now we do our math. And when we do our math, we simply discount the cash flow streams back and subtract the original investment. So here we have 40,000 out, and in problem 1, we discounted the 15, 12, and the $310,000 withdrawals back, and then we subtracted the 40,000 out, and we see that an NPV in project 1 with an interest rate of 5% or a discount factor of 5% shows a net present value of $10,324. So what does $10,324 mean? It means that if we discount the cash flow from project 1 back at 5%, we get a number, and then we subtract out the 40,000 we put out, and we end up with a positive cash flow of $10,323. Another way to look at this is if we're not putting our own money into this project, we have to go to the bank, and a lot of companies do. They go to the bank, they borrow, and they build the project. Well, if we went to the bank and we borrowed money for this project, and we borrowed $40,000 and we invested in the project, and we built the building or put out the product line or whatever we're going to do, and the cash flow from that business, the free cash flow that would come to us as owners at the end, was the 15, 12, 50, 10, 10, 10, and we discounted that back to today at the interest rate of the investment, in this case 5%, we would be able to pay the bank back the $40,000 that they lent us and still have left over $10,324. The bank would get its interest and its principal back, and we would get $10,324.25 for doing this project. Now, if we do project 2, we would get $12,723. That's if we could borrow at 5%. See, the timing of these cash flows is very important. One is front-end loaded, one is back-end loaded, and the interest rates are going to pay a little bit difference because we're paying more interest to not get our cash back as quickly. As you see here, with a 10% interest rate, we only have $4,500 in profit or net present value in project 1. Project 2 only has $4,097. So the timing of the cash flows has a lot to do with how much money you're making. Obviously, the sooner you can pay back the loan, the better off you are. So you want your money to come in as soon as possible, although most projects, a lot of projects, give you a lot of money in the back end in the later years as they mature. So the timing of the cash flows is important. So we always run all the math on all the numbers and look at it before we make judgment calls on this. So both these projects are positive, however. Both these projects have a positive net present value. That means if we borrow at either of these amounts and invested this money, we would end up with a positive gain. Now, when we say borrow, companies borrow all the time. They have debt on their books. They also have money from shareholders. So there's debt and equity in most corporations. And the debt and equity will combine. They both have rates of return that you need. And they combine to a weighted average cost of capital. And that's the hurdle rate, or the rate that every project has to go over, or it's not profitable to the company, because they have bondholders they have to pay, and equity holders are expecting a return. So this is the minimum threshold. So if that, in this company's case, was 10%, these would both be positive projects. One would make $4,500 and one would make $4,000, and of course these would probably be in millions or tens of millions of dollars to be in corporate America kind of projects. But nevertheless, the idea is they're positive. That would be good. But if they weren't, if they were negative, then we wouldn't do them because they wouldn't generate the returns that we want to earn. So the lower the interest rate, the more return it'll generate and the more projects you'll do. More on that in upcoming sessions. Also, the internal rate of return is what sets NPV to 0. So as you can see, at 5%, it's $10,000 in project 1. 10%, it's $4,500. You can see it's going towards IRR at 14.72. At 14.72, the amount of cash going out is equal to the amount of cash coming in. So at a discount rate of 14.72, that would be the rate of return you would get if you just simply all paid cash for the investment and put your $40,000 into it, the rate of return you would get from those cash flows would be 14,723, and there would be nothing left over. So that's what IRR does for you. Now there's going to be more on IRR and NPV in several weeks. The reason I brought this up here is because that payment key gives you the idea that everything's a mortgage and everything's a car payment. Almost all of finance is not a regular payment. There's payments, of course, mortgages and cars and the rest of the stuff, but most of it is an irregular return, and we're looking a lot at net present value and net present value type calculations to be able to pick up that irregular or uneven cash flow. That's why I brought it up. The second thing is we want to be able to put this into words. If project 1, if we invest $40,000, we get a return that starts high and falls lightly for a net present value of $10,324. At 5%, it's $45.19. At 10%, IRR is 14.72. And of course, project 2 is very similarly worded that we can talk that way to a CEO, CFO, etc. How would you say it to someone else? That's a little different question. When you look at the numbers here, you can probably start thinking about this on how you would say it to someone. If we borrowed $40,000 and we had to pay 5% interest on our money, we would get cash flows of, and we got cash flows of 15, 12, 5, 10, 10, 10. We would end up being able to pay all the bank all the way back and walk away with $10,324. So that would be one way to look at the investment side of the equation. We'll get more into this as we go. The spreadsheet work will be in a different video, but the idea of uneven cash flows is going to be very important, so I thought I'd bring it up early. If you get all this, you'll see it in the spreadsheets on how you can get it there. So net present value IRR, extremely important. Let's move on and look at some spreadsheets.